Welcome to another video. If you are new on Xtrade channel, please consider subscribing to the channel, hit the like button and also feel free to leave a comment down below. In today's video we will talk about the forex market and almost everything you need to know before you start making money in forex market. What is the forex market? The global foreign exchange markets, also known as forex, represents the platform by which currency from one country can be exchanged into the currency from another. The value of currencies around the globe constantly fluctuate depending upon a whole variety of factors, and will range upwards or downwards depending upon the economic stability or instability of the countries which issue them. It is these fluctuations in value that present the opportunities to make money. Put simply, this means that if a country's economy is performing well, then it is likely to result in an increase in the value of the currency of that country. Alternatively, if an economy is performing badly, then this is likely to lead to a reduction in the value of that currency. The forex market can offer fantastic opportunities to traders from all walks of life. It is possible to make good returns on your investment, and many people successfully manage to turn their trading activity into full-time jobs or good second incomes. The chance to profit from the relatively small fluctuations and changes in the values of currencies means anyone can have a go at trading, and with the vast array of conventional and online tools applications that are currently available, it is relatively easy to get started and begin trading. Before you start investing your money in forex market, it is best to get the warnings out of the way so that you are aware of them and can then decide whether forex trading is right for you. As with any type of financial trading, there are risks involved, and it is important to understand these risks, as you can then develop strategies and learn methods that can help to reduce them. Forex trading carries a high level of risk to your capital, with the possibility of losing more than your initial investment, and may not be suitable for all investors. Ensure you fully understand the risks involved and seek independent advice if necessary. It is likely that anyone considering trading in the foreign forex markets will have come across the above statement at one time or another, and those that haven't yet, soon will. It is a warning that you will quickly come to recognize in the course of day-to-day trading, and it is also an extremely important message to remember. The truth is that there are risks associated with forex trading, as with any type of trading, and it is important to understand and accept these risks before progressing. Failure to understand the risks and prepare for what is involved with trading is likely to lead to financial losses. However, by taking the necessary time to learn and understand how and why the market works as it does, and acquainting yourself with essential trading knowledge, will considerably increase the chances of success. There are many videos on YouTube and resources available that will try and tell you that they have discovered the perfect trading setup or offer promises of guaranteed returns. The truth is, there is no magic setup or guaranteed strategy out there, as much as we all wish that there was. Even institutional trading houses with advanced quantification strategies and teams of analysts will struggle to predict market movements correctly 100% of the time. Forex trading must be approached in the same way as one would approach any other job. A successful trader is defined as one whose losses over the long term are overall less than their gains. Losses are a fact of life, and every trader at some time or other will experience them. The best tool available for maximizing returns and minimizing losses is market knowledge, and it is this that we have created this channel. What is the size of the forex market? The forex market is huge in size. Close to $5 trillion worth of currency is traded daily, making it by far the largest financial market operating in the world. Of this, approximately $1.5 trillion is traded by retail traders, trading the forex spot market. The total forex market value represents many different activities, which will require the exchange of one currency into another. Businesses making overseas purchases or dealing with foreign suppliers and customers, international mergers and acquisitions, and interbank dealing and transfers all require money to be transferred around the globe and converted into different currencies. This is achieved using the forex markets. Market structure. The trading of stocks and shares is predominantly conducted through centralized exchanges, which means that the price at which securities can be bought and sold is controlled and manipulated by a few dominant institutions. There is therefore little opportunity to seek a range of prices for buying and selling within the marketplace. The forex market, however, operates using a distinctly decentralized structure. Many institutions and organizations can offer currency transactions at a variety of different prices. This means that there is the opportunity for a variety of quotations amongst dealers and the chance to buy and sell at a range of prices. This type of decentralized organization can initially seem confusing, however, by its nature, it actually provides considerable opportunity for retail traders. The competition that exists between institutions and market players actually ensures that the best possible pricing deals are available all of the time. In the forex market, there is still a degree of structure amongst participants, and it is useful to understand how the main elements of the market interact. At the top of the forex structure is the interbank market. This comprises the world's largest banks and some of the smaller regional institutions that trade directly between each other using two standard systems, the Electronic Brokering Services, ECB, or the Reuters Dealing 3000 spot matching. Both these systems allow the larger institutions to transact easily between themselves, with minimal costs and maximum efficiency. The next level of the structure comprises hedge funds, retail market makers, and business institutions. This tier of participants utilize foreign exchange mechanisms, either as part of global business operations, or for speculative investment purposes. Operating at this level requires strategic partnerships, where transactions will generally be directed through commercial banking partners. As such, the costs participants incur in order to transact are higher than those experienced at the institutional level, but still more favorable than the terms available to most retail traders. At the lower end of the forex hierarchy are the retail traders. A diverse group, retail traders range from day traders who will trade every day placing multiple transactions, to irregular participants who only trade now and again. The value of transactions at this level is equally varied, encompassing all budgets. Costs of trading are higher and the terms of activity less favorable, since there are two levels above the retail trader charging fees on every transaction. Access to the currency markets in the past was much more complicated and costly, but with the introduction of internet-based retail brokerage, it is now much easier to actively participate within the marketplace. This means that there has never been a better time to begin to learn how to trade forex. A quick difference between forex and stocks market. Many of the techniques used to trade the foreign exchange markets are equally applicable for the trading of stocks and shares. As a forex trader, you will find that the skills learned and developed in order to effectively trade can be easily applied to trade other financial securities. Despite this, though, forex trading does have some distinct advantages over the trading of other financial instruments, particularly in terms of the possibility for larger returns on investments. The main differences of trading forex over stocks include 24 hours market. No matter what the time of day or night, you can trade around the clock owing to the global nature of the forex market. Commission-free trading. Liquidity. The forex market is extremely liquid owing to its sheer size. This means that there are always buyers and sellers active in the marketplace. Stops. Most brokers provide guaranteed stops when trading. Leverage. Traders can apply leverage to trades in order to maximize potential returns. Identifiable trends. Easy access to market news. How to make money from forex trading. The objective for anyone trading the foreign exchange markets is to exchange one currency for another in the hope that the price of the currency bought will increase in value compared to the value of the currency sold. The way this is achieved in forex trading is through the use of a currency pair. A trade will always be based upon two currencies, known as the currency pair. This is because every time you make a foreign exchange transaction, you are essentially buying one currency and selling another. Each pair will always be presented in a similar format. The first currency in the pair is known as the base currency and the second known as the quote currency. Together these form the basis of the exchange rate, so that when buying, the quote currency tells you how many units of that currency are required to buy 1 unit of the base currency, and when selling, the exchange rate tells you how many units of the quote currency you can receive for every 1 unit of the base currency sold. The exchange rate described by the currency pair means that the base currency provides the basis for all transactions. Therefore, if you were to place a buy order for the British pound United States dollar, you would be buying the base currency British pound while simultaneously selling the quote currency United States dollar. Conversely, if you were to sell the same pair, you would be selling the base currency British pound whilst buying the quote currency United States dollar. Note, in order to make a profitable trade, you would buy the currency pair if you thought that the base currency will increase or appreciate in value in relation to the quote currency over the period that you hold it for, or you would sell the currency pair if you expected that the base currency will depreciate or decrease in value relative to the quote currency over the period. Currency pairs. In practice, when currencies are paired, then the one that performs better over a given period will rise relative to the other. It is the movement of these currency pairings that forms the foundation for making profits or losses on investments. Here are some of the major currency pairs and their abbreviations. A number have alternative nicknames which are regularly used by experienced traders and are useful to know. Euro, US dollar. Pound sterling, US dollar. US dollar, Swiss. US dollar, Canadian dollar. US dollar, Japanese yen. Euro, pound sterling. Euro, Swiss franc. Australian dollar, US dollar. New Zealand dollar, US dollar. Official market open times. The forex market is a truly global entity offering the opportunity to trade 24 hours a day, apart from Saturdays and Sundays. The various major markets around the world open in accordance with their local time zones. When to trade? Despite the forex market being open 24 hours a day, there are times when it can be more advantageous to trade than others, particularly as a newcomer to the market. The best trading times relate to when there are high transaction volumes and intensive market activity. Optimum times for this tend to be midweek and when multiple markets are open. For example, it is generally better to be trading when both New York and London markets are open and overlapping, rather than trading when there is only access to one of the larger markets. This means that it is important to pick both the day of the week and the time of day that you feel will be most favorable in terms of market participants and transactions. There are a number of times when it can be best to avoid trading altogether. Mondays markets often react unpredictably to weekend news and activity. Fridays often produce low volumes and market participation as traders prepare for the weekend. Weekends there are vastly reduced volume levels at this time of the week. It can be a good time to prepare for the fundamentals of the week ahead. Holidays. National holidays have similar problems to those experienced at the weekends. Significant news events. Although it is good to be prepared to take advantage of news releases, trading immediately after these events should be limited to more experienced traders. Thanks for watching. Hope you guys have enjoyed the video and please don't forget to like and subscribe to the channel. I'll see you in the next video.